And this is due 1 week from today. Bless you.
So
This will be
next.
homework number 4, and you guys should have one more to go after. And on the topic of homeworks, just to clear, oh yeah, here's the, let me pass out the remainder of the homeworks that you guys turned in. Here you go, Crystal. Mario. Sure, yes, Mel. Okay, so just real quick to finish up the last homework here, just a few things I'm a little concerned about. I'm sort of concerned that not everybody still understands the difference between coupon rate and a yield to maturity. So I'll just clarify that real quick. I'm sorry for the review for those of you who understand. But the coupon rate is the rate that firms pay on the bond. Firms make periodic payments. This is the actual money that leaves the coffers of the company and enters the hands of investors. Okay, this is not to be confused with the rate, with the required rate of return, or I over Y, or yield to maturity, which conversely represents how much investors demand. Okay, so when an investor is going to trade with another investor, that rate is going to be relevant. The company doesn't really care about that rate after they've issued the bond. That rate's going to fluctuate up and down based on the risk characteristics of the company, risk in the market, all this sort of stuff that comes out. The yield to maturity is going to change, but the company is not going to care about it. Okay? The company cares about yield to maturity on one day, and that's the day that it issues the bonds. At that day, the amount of money that the company receives is going to be a function of the yield to maturity. And you guys will recall that if the bond's issued at par, then the company is going to receive $1,000 for every $1,000 it promises to pay out. If the yield to maturity is higher than the coupon rate, investors demand more than what the company is actually paying, then the bond's going to be issued at a discount. If it's less, then the bond's going to be issued at a premium. Okay? If somewhat of that is unclear to you, I strongly advise that you come see me during office hours or send me an email or something, because this will come up. This is a relatively important concept here. So just make sure you're 100% on the difference between coupon rate and yield to maturity. And let's see. Okay, so the face value of the bond is always $1,000 unless specified. The amount of payments in a year is always 2 unless specified, unless otherwise specified. So that's review. On day 0, the only money that changes hands is that investors give the firm money. There are no coupon payments on day 0. On the last day of the maturity, when the bond comes to maturity, then there's really one transaction, but you can think of it as consistent of 2 parts. There is that final coupon payment and the return of the face value, which again is always $1,000 unless specified. We don't need to make yield to maturity calculations on what the face value will be, because that'll always be $1,000. Just a fun fact there, unless otherwise specified. Okay, so far, do we have any questions? All right. That being said, there's a few things I can and will do on the test to hopefully clear up some of the confusion that was present in this problem set, particularly when I was explaining it. One very simple thing I could have done instead of giving you guys annual inflation rates for the tips problem, I could have just given you guys periodic inflation rates and saved you a headache explaining it. So I apologize about that. I did not mark off too severely for that on the homework, and this is a problem that you don't have to worry about coming up in the exam. Another thing, just want to point out that I wanted to give you the last question on the last homework to challenge you. It is very unlikely that you will see something as rigorous on the exam. But you will have to understand when a firm will call and when a firm will not call, at least at the conceptual level. Yeah, that's all I can say right now. So in the review session, we'll try to go over a problem like that. Okay, is there someone else? Yeah, Fabian, you didn't get the homework? New homework, just for you. Everyone else? Mario, did you get new homework? Yes.
Yeah, we can do another one of those McNally things.
Yeah, well, I plan on doing a review session here. If one review session won't be enough, I can schedule another one, depending on how you guys feel. I think it would be really helpful for everyone if before my review session, hopefully before the weekend before my review session, you guys can email me concepts that you're unclear about. That way I can help cater the review session to you, and that will also give me an indication of whether or not I need 1 day or 1 day and McNally day, something like that. So just an extra option for you. Of course, the McNally class isn't a real class, so I can't rely on you guys being there, so I need to try to schedule everything in that class, and if you guys want some more detail, then it'll have to be outside of class, because I unfortunately don't have as many class periods to work with. Okay, check.
President?
Yes, sir.
So our final exam will be May 5th?
Correct.
And it will be in this class during this time frame?
Exactly. Very likely, I will probably give you guys bonus time like I did in the last exam, because I really don't care how long it takes you to get these problems, as long as it's in your head somewhere.
Are we allowed to, any type of note cards or?
No, all the formulas that you'll need I'll provide again. The concepts are sort of for this and not for the note cards. So yeah, and yeah, I'll probably have some more details on the exam as we get closer to it. And let's see.
Our project is due that week before, right?
Yes, the week before the exam, you guys will be presenting your projects. Yeah.
When are we gonna get
What's that?
information on that?
So that'll be the last week in April. I'll give you guys 2 weeks notice. Is that fair? Does anyone want more notice? Okay, I figured if you guys are anything like me as students, you probably don't start the projects 2 weeks ahead, so. Okay. I think that's all the there's one more thing. So,
We have 3 weeks.
Pardon?
3 weeks ahead.
3 weeks ahead?
Yeah,
As long as you promise to start at 3 weeks ahead.
I'll
What's that?
think about
Can we
it.
do 3 weeks, cause I have an investments project the week before.
Sure. I guess that means I need to give you stuff now. I can come up with it over the weekend, it's not a problem.
I mean, you said we're gonna pick groups again, right?
No, I said it's gonna be randomly assigned. You guys don't pick.
Yeah, like,
Yeah.
basically.
Right.
So, I'd at least like to know that, so.
Sure.
Concepts of.
The groups? Yeah, we can draw groups at the end of this class if you'd like. Does that work? Okay. One last caveat on the homework. There is a lot of collaboration on the homework, which is great. Collaboration has a nice connotation to it. If it's cheating, that's great too. I don't care to know about it. But the point I want to make is that this homework grade is negligible. It's totally like if you guys really need those extra couple points, you can come beg them from me and I'll be happy to oblige. The point is that you need to understand this, and you will not be able to collaborate and or cheat on the final. So if you have to do what you have to do to get through these homework assignments, by all means, don't let me stop you. But it's really going to impact your actual grade on something that's weighed a lot more heavily, the final, if you don't understand these concepts. So maybe you don't understand them now, maybe you have to collaborate, fine, but by the time of the final, please do yourselves a favor and inform yourselves enough to go from here to the paper without using other resources. Okay, that concludes my pep talk for the day. So now we will finish up stocks, including another example, and just give you some outline on how stock markets work. And then we'll start mortgage markets. So for you syllabus readers, this represents the end of last class and the beginning of this class. So the beginning of chapter 14, I guess, is mortgage markets, and the end of chapter 13. So running half a class behind, I apologize. And all right, so you guys want to start with a problem, or you guys want to start with the general how stock markets work? Problem? All right. So here we go. This is going to combine a couple of concepts. One concept that we talked about yesterday and our last class, and concepts that we're borrowing from quite a few classes ago. So, setup is as follows. Stock pays annual dividends, and the appropriate discount rate for that company is 10%. Okay? You plan on holding the stock for 3 years. Okay. Now, the question is going to be, what price will you pay for the stock today? So, what information will we need to answer this question?
The dividend that's being paid.
Okay, so we need dividends. What else?
Stock price
Stock price.
currently.
So the question is, what price will you pay for the stock today? And that's going to be the stock price term.
Do you need the dividend growth rate?
I'm sorry.
That's fine.
Two people said.
Do we need the dividend growth rate? Yeah, that's fine.
Okay, that's relevant. Okay. Anything else that could influence our decision? I'll give you a hint. There is something else that can influence our decision.
Expected return.
Expected return in what sense? You're onto it, but pardon?
Selling price.
Selling price. Yep.
Risk-free rate?
Risk-free rate is going to be factored into this discount rate. Remember, this discount rate is always going to be the risk-free rate plus some risk premium. That's from interest rates in chapter 3. So it's going to include the risk-free rate. But we're going to need the selling price. Now, why didn't we need the selling price in the last example to calculate the price of the stock? You guys remember the last example? Does anyone have a guess? It wasn't explicit, but. Taylor?
Because there was a forward contract?
Yeah, okay.
I mean,
So
it's
that
essentially
that makes sense.
selling price.
But to calculate, so we were trying to look for how much value is in that contract. But to calculate the difference, it would be the difference between the fair price for the stock and what we locked in, right? That difference is going to be the value in the contract. But to calculate the fair price of a stock that has a constant growth rate or that pays constant dividends, which is a special case of a constant growth rate equal to 0, you calculate that price assuming that you're going to be getting payments to perpetuity. You're going to be getting payments forever. This company's never going to go default. You're always going to hold on to the stock, or whoever holds on to the stock is going to be always getting payments for as long as the company
So
lives.
the price you paid for it.
What's that? Yes, that gets factored into the price you pay for it today. We have a different case here. We have a case where we know for sure that we're not going to be holding this stock forever. So we need to figure out how much we're willing to pay for a stock that we're not going to hold forever. Okay? So that's the little modified example here. And can anybody tell me what the fair price for any asset is? What's that? It's not going to be a number. Yeah, that, 1,000 is the common price, common face value for stocks. But,
Can you repeat that?
sure, what is going to be, it's a conceptual answer here.
So liabilities plus plus equity?
So,
Is that assets equal?
yeah, that's a good way of thinking about it. That's gonna be the market value of anything. So, liabilities plus equity, that's gonna be difficult to tie into this example, but that's the price of a company's assets. Taylor, do you have another guess?
Your expected cash flows?
Yes. So the correct price for any asset, be it a financial asset or a non-financial asset, is the net present value of expected future benefits, okay? In the case of finance, we almost always restrict our expected future benefits to financial expected future benefits, money, okay? So the net present, the price of any asset in what we're dealing with here is going to be the net present value of its expected future cash flows. I'm going to write that down because it's important. It's one of those sort of creeds that they shove down your throat from the beginning of finance all the way to the end. So I draw the distinction here because owning a Maserati provides you with an expected future benefit. You get to drive around and say you own a Maserati, which presumably you're going to build into the price you're going to pay for that Maserati. It's going to be important to you, but it doesn't come with any positive cash flows. It comes with a lot of negative cash flows, actually. So in finance, we can really think of expected future benefits only in the sense of expected future cash flows. So this particular financial asset, the stock, has two expected future cash flows, two categories of expected future cash flows. Dividends and what you sell it for, okay? So let's be rigorous about this and map out our cash flows like I asked us to do in problem number 2. So time 0, time 1, time 2, and time 3. Are we going to have any payments in between? No. Why is that, Elizabeth? Yes, exactly. Annual dividends. So what we need to do to figure out how much we're willing to pay for it today is figure out what these cash flows are, okay? Here we know we will have an expected dividend. Here we know we'll have an expected dividend. There we'll have an expected dividend and an expected sales price. Okay. With that in mind, I can present the rest of the question for us. So there is a dividends. There's okay. So, with respect to dividends, there's a 50% chance that we'll have a dividend stream as follows. Okay? First dividend is $3, the next one is $4, next one is $5. Okay? There is a 50% chance that we'll have this alternative dividend stream. Okay? Similar concept with sales price. Ruben?
Wait, so what all would be given, or like if we just ask the problem,
everything here. So far, you haven't had to calculate anything. The only time I stopped, I asked you to think about concepts so far. Yep. So the question remains here. What will you pay for the stock? So sales price, similarly, we have a good scenario where with 75% likelihood we predict it'll be the good scenario and we'll be able to unwind the stock for 40 bucks. 25% likelihood we predict it'll be the bad scenario and nobody will want the stock and we can only get 20 bucks for it. Okay? So can you guys try to walk me through how to calculate this? Borrowing concepts that we talked about, that was tested over your first exam for sure, and we talked about probably once or twice since. Anyone got a guess? Taylor?
You can break it down into, I guess, weighted cash flows. So both the threes, you have a 50% chance of getting $3 in the first one. So it would be 0.5 times 3 plus 0.5 times 3.
Which is just going to be 3.
Follow
Yep.
through, yeah.
So the first cash flow is known for certainty. No real expectation here. It's going to be $3. Okay? What about the second cash flow? 2? Why do you say that?
Average 4 and 2.
Yeah. So exactly, yep. Expected value is 2. And this last guy right here, 3. So what we did was weight 1 times payoff 1 plus weight 2 times payoff 2. These weights were, in the one case, I'm just going to write up the middle dividend here. So 50% times 4 and 50% times 0. Okay? Now, what about this guy right here? Same deal. What's it going to come out to?
3.
What is it? 40?
No, 35.
35. So 75% times 40 is 30, 25% times 20 is 5, 30 plus 5 is 35. Okay. Okay. Now what do we do with these cash flows?
Discount them back,
Yes, and how do we do that, Sam?
divided by 1 plus the, discount rate to the first power.
Okay.
And then the next one would be same thing, but to the second power, because it's second year.
Okay.
And then the third one would be the same thing for the third year.
Perfect.
Sorry, how'd you get that?
How to get that 35? That is this same formula here, except we have, I'm sorry, I should start with 75% chance that we'll get $40,
Oh, okay.
right? And 25% chance that we'll get $20.
No,
Pardon?
that's not divided.
No. So dividing by 2 works if there's an equal weighted chance here, but here we have unequal weights to these likelihoods. So weight 1 is going to be 75%, weight 2 is going to be 25%. Does that make sense? Okay, so before I go any further, I'll stop here and ask, is it worth catching anyone up? Is anyone lost so far?
How do you get the 3, 2, and 3?
How did we get 3, 2, and 3? Perfect. Good question. So this exact same formula. All right? So 50% chance that we'll get $3 here. 50% chance that we'll get $3. Well, that's just going to be 100% chance that we get $3, right? This first cash flow is going to be 3 for sure. This one, 50% chance that we'll have $4, 50% chance that we'll have nothing. All right? So that's going to be 2.
Okay, good.
And then we do the same for the other calculation. Okay. So what am I going to write in the numerator here?
Cash flow
Which,
from first year 1 and second year,
so 3,
2 and 3.
38.
Oh yeah, 38.
We can alternatively do this 3, 2, and 3, and then have another thing here that discounts the same one. Just saving ourselves a step. Okay? and the rest is as easy as plugging this into a calculator. Okay? So, this is another potential type of stock question that I could ask. Once you get this value, I could also ask, suppose you entered into a contract, or let's say, suppose you know someone who's selling the stock for X dollars, and that X would be below whatever the fair price is. What would be your arbitrage opportunity? And that would just be the difference. I could do variants of it, but this is the core calculation. Because the current price, the correct price of any asset is the net present value of its expected future cash flows. Jackson?
No, that's the equation for discounting that present value.
Yes, precisely. Yep. We have several cash flows. We need to discount each of them. Okay. Does anyone need a few more seconds to finish writing? Yep. Take your time.
There's one in the Union. There's, what else is down there? Like a pizza place, a Chick-fil-A.
I would just go to the Yeah, the market, that's.
Yeah, you just go more on down that,
Coming from the price, you go more that way? I don't know anything about that.
well, I mean, more down that aisle, you know, past Starbucks. You just keep going straight.
Okay.
Yeah, I didn't know they had those places either till recently, and I've been going here forever.
32.92, would that be the right?
If you say so. Anyone who did the calculation.
You can't hardly find a Quiznos anymore. What's up with that?
Subway's just too darn efficient. It's cheaper and
Well, not anymore.
Quiznos got to be Subway prices.
Well, now it's like $7, and I mean, my sandwich
Subway
was.
prices?
Yeah. They used to be like $5, but now they're not anymore. They just
No
do
more
that
$5
for.
for lunch?
Mm-mm.
Wow. I've been out of the game for a while.
Yeah, so.
Hey, so on the selling price where you said we need to know the selling price, so is that where you just put in, you made,
I like Quiznos.
you did the sell price is 75% chance at 40 and 25% at 20?
Yes. And I gave you potential sales prices, and you calculated the expected sales price. Here's another question. I won't do it on the board, but think about it. On that day, what's the actual sales price going to be if I tell you that dividends are going to grow from the next period at a constant rate of, 3%? You could probably be able to figure out what it's actually going to sell for. This is our expectation, what it's expected to sell for, but I can change the problem up and see, all right, so you paid this much money for it because you expected it to sell for that much, $35. It actually sold for $26. How much money did you make? What was your actual return or something like that? I can give you variants of it. And you'd be able to figure out how much it sold for based on using your Gordon growth model. That's the one where the present value of any asset equals the present value of a stock equals the dividend next period divided by the discount rate minus the growth rate. R minus G.
And we would add that in, right?
Yeah, you would factor, depending on which question I'd ask, but it would be some variant of that. So you should also be comfortable calculating that stuff. Okay, real quick, let's just talk about how stock markets actually work, because it would probably be irresponsible of me to leave you with no sense of that in the class. But we talked about the difference between over-the-counter markets and exchanges. And I brought it up sort of preliminarily. I gave you an overall definition. Luckily, in the realm of stocks, in the United States and in the world, the two biggest markets happen to be an over-the-counter market and an exchange. So, the exchange is called, this is my abbreviation for exchange. Nah, it's going to confuse you guys. It's just how I always write it. But exchange
decent on that line, we tested on that.
No.
National what? Association Securities.
National Association for Securities Dealers Automated Quotation System. NASDAQ. NYSE is much simpler at New York Stock Exchange.
Yeah, I knew that one.
Jay, you should know me better than that. Okay. So, a few facts. NYSE is the world's largest and most liquid market. It's a hybrid market. It's called a hybrid market. So at the time the book was written, NASDAQ does about a fourth of its trading, or about a fourth of the trading that takes place on NASDAQ is face-to-face trading, those crazy people yelling, buy, 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 sell, 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 that you see in movies. And 3/4 of it is more tame online. So they are now a hybrid market. They're not purely an exchange. But, yeah. E-trade. So these are the biggest stock markets. They are not the only stock markets. There are regional stock markets. I think Philadelphia has a pretty big one where like smaller companies go to trade. Why don't smaller companies trade on either of these two? Because these guys have listing requirements. So each exchange will say that, look, company, if you want your stock to trade on this exchange, you have to meet these requirements. And NYSE, for instance, has a size requirement. It says that you have to be above, I think it's $10 million in net income over the last 3 years or something. You have to average above $10 million in net income per year, or you have to have above 100 million in market value, which is just your stock price times the number of shares outstanding. So if you're a big company, you can trade on this guy. NASDAQ also has some listing requirements. I don't know them. Another thing you have to do to trade on exchanges is you can't be in default. If you miss a payment, NASDAQ and NYSE kick you off their exchange because those stocks that are in default are much less liquid. And these exchanges make their money. These are for-profit industries, by the way. Unlike other stock exchanges in other countries, these are not run by the government. The SEC has a heavy hand in regulating them, but these guys make their money per trade, right? So they want a lot of trades. They want really liquid stocks. And chances are, if you don't meet the size requirements or you're in default, you're not going to be that liquid. People aren't going to be trading. So they don't want you on the exchange.
Isn't the NASDAQ like a majority of technology, like technological stuff?
Does it have a lot of tech companies? I personally, I don't know. I can find out for you. But I know generally smaller companies list on NASDAQ, but still very liquid ones. Otherwise they would just trade on local exchanges, small exchanges. But it makes sense that technology companies would fit into that bin. I don't know exactly. I can find out what the industry breakdown is for you.
How does the Russell 3000 compare with these?
So the Russell 3000. Okay, so the Russell 3000 is what's called an index. What an index is somebody somewhere decides that, hey, here's a list of 3,000 publicly traded stocks. Let's say the guy's name is Russell. I am going to track the performance of each of these stocks. If the stock price increases, I'm going to track that. If it decreases, I'm going to track that. Basically, one easy way of doing it is say, let me invest in 3,000 different stocks. I'll put different weights on it. And as these stocks increase, then the value of the Russell 3000 will increase. As they fall, value falls, right? More common than the Russell 3000 is the S&P 500. These are the 500 biggest companies in the United States, basically. Even more common or even more useful than that is the Dow Jones Industrial Average. That's another index. And that basically is supposed to be a good indicator of the overall economy, because these 32 companies that are in the Dow Jones Industrial Average are basically the biggest companies from various sectors. So if we have a shock to one sector that doesn't bleed into the other sectors, then the value of that index is going to go down. If we have an economy-wide shock, it's going to affect all sectors. Value of that index is going to go down a lot more. Russell 3000, I think, tracks small cap stocks. So growth stocks, little guys that are getting big. There's a whole bunch of different indexes that you can invest in. S&P 500 is probably the most famous one. So yes, not to be confused with these exchanges. All of those stocks presumably trade, most of those stocks definitely trade on one of these two exchanges, but some of them, especially for the small cap stocks, Russell 3000, will probably trade on other exchanges too. Does that make sense? Cool. Okay. So, talked about NYSE a little bit. NASDAQ is a true over-the-counter market. I should probably get that. Yes, I did. Which means that who makes the market in over-the-counter exchanges? The public, but the public does not transact in over-the. Every public person that is transacting with one entity. That entity is a dealer. Dealers are sort of the market makers in over-the-counter exchanges. So dealers buy and sell inventory. Okay? And the way this works is, I'm not putting this up here because I don't intend on testing you on this, because these are kind of like nitpicky details that if you ever want, you can find out on your own. But the NASDAQ has dealers that will put a price up. Okay, they will put a bid price. And bid means how much you want to buy something for. You're bidding for something in an auction, that means you're willing to pay for something in that auction. Okay? So dealers put a bid price, and they are contractually obligated for a particular security, and they're obligated to buy at least 1,000 shares of that security at that price if an investor is willing to trade with them. Okay? There's probably some sort of staleness requirements. If nobody wants to trade with them for, I don't know, a week, 2 weeks, then the bid falls off. But until that happens, they cannot enter in another bid. A particular dealer cannot enter in another bid. Okay? Similarly, the ask price is what they are willing to sell the security for. Okay? So they're selling a security, they want to sell 1,000 shares of Google, they're asking $50 per share. That's ridiculous. They're asking $500 per share. And same thing goes. They put in a quote. If anybody wants to meet that quote, they they have to execute at least 1,000 shares of that. So, yeah. So the dealer makes its money basically by bidding low and asking high. Okay? This difference here is the bid-ask spread. Common term in finance, common term in market microstructure, which is what we're studying here. And it represents the dealer's profit margin. It executes a purchase order for $50 and executes a sale order for $51, and it makes $1 per share. Okay? That's the bid-ask spread, and that's sort of a proxy of how liquid a stock is. So stocks that have very narrow bid-ask spreads means so many people are trading on it that dealers can't really afford to make much money on it because they can just go to another dealer. That means the market's really competitive. If, on the other hand, there's a lot of uncertainty in the stock, no one knows what the stock's really worth, then people are going to be more hesitant to buy. And dealers are as well. So dealers are going to try to make a lot of money on these uncertain stocks because what if, God forbid, they were to buy the stock and then nobody wants it and they can't unwind it and they lose a lot of money? So they're going to demand a high bid-ask spread on riskier stocks. In general, risky stocks are less liquid than safe stocks. Okay, this is why it doesn't just extend to stocks, it's any asset. This is why treasuries are the most liquid, because they're the safest. Everyone knows they'll always be able to unwind treasuries. So these dealers in over-the-counter exchanges are called market makers, because without them there wouldn't be a market. The market goes through them, okay? So this is in contrast to how things work at NYSE, okay? NYSE has, I will put over the counter. NYSE has specialists, and they are NYSE employees. Dealers in NASDAQ are their own men. They take orders from no one, okay? They take orders from their bosses, but their bosses aren't NASDAQ. In contrast, specialists are NYSE employees, and their job is to provide liquidity. That means if an investor like me wants to trade 1,000 blocks, 1,000 shares of, I don't know, Apple, and a bunch of other investors want to sell 1,000 shares of Apple, and nobody wants to buy any Apple, it's these specialists' job to buy some Apple. Does that make sense? So even if these guys are losing money on the transaction, they're legally obligated to buy Apple, to make the market, to provide liquidity. Okay? So, stock specialists. And it's not on a stock-by-stock basis, it's on a group of stocks. So let's say Yum Brands and Coca-Cola will have the same specialist. Let's say, I don't know, the 3 railroad companies will have the same specialist. So these guys' job is to monitor the demand and supply of stock and to try to balance it. Even if the demand, really outweighs the supply, then they will have to short sell stocks. If the supply really outweighs the demand, if a bunch of people are trying to sell the stocks, they'll have to buy them. Okay. And the last thing I want to talk about, are these newish electronic communication networks. Can I erase this stuff, guys?
So the dealer is the market maker, and that's over the counter?
Yes, in the over-the-counter exchanges, these dealers are market makers. The term market maker really refers to dealer. You don't really use the term market maker to describe these specialists because it has a very specific meaning, but these guys perform the same function effectively.
They both do the same job essentially, right?
Yes, these in a little different ways. These guys are legally obligated to provide liquidity, and these guys are basically your car dealership. That if you want a car, go to them, and they have plenty of cars.
So the market's tanking and everybody's trying to liquidate, they're not forced to purchase?
Nope.
They can just sit back and say, no one's buying.
Exactly.
But the stock specialists on the NYSE, they have to take it in no matter what.
Exactly. Precisely. Okay, and then the last thing is what's called a electronic communications network. Okay, this is a group of large financial institutions that know exactly what it's like to be the middleman, because financial intermediaries are by definition middlemen, and they know what it's like to profit as the middleman, and so they decide to cut out the middleman in their stock purchases. This is Fidelity conducting a transaction with Charles Schwab. Right? And they have these platforms that they conduct these transactions on, and these platforms are called electronic communications networks. These platforms have some benefits to them, namely transparency. So on these ECNs, everybody that puts in any kind of quote, and a quote is either I will buy for this much or I will sell for this much, either of those are considered quotes, that's all public for all the other members of this ECN to see. In contrast, the prior two systems that we have, it's very difficult to see who's trading when. And the exchange has that kind of information, but individual users do not have that kind of information. So if Fidelity wants to trade on NASDAQ, wants to trade 100 shares of Apple on NASDAQ, they can't see how much Charles Schwab is willing to sell that for. And so they don't know how much to bid. In contrast, in these ECNs, everybody sees everybody else's order. Okay? So it's more transparent in that way.
This is primarily banking then that uses this?
No, just large financial institutions. These are basically all the dealers that work in NASDAQ that just decide to cut out the middleman. Well, let me say, I don't know that for sure. I would imagine the same people who are sort of financially savvy and monetarily endowed enough to operate on these big networks are also capable of being dealers in NASDAQ. They also buy and trade shares, buy and sell shares in there. So yeah, I can find out for you. So transparency. We talked about another benefit here is cost reduction, because they don't have to pay the exchange fees. And a third benefit, it's actually very important. You have 24/7 trading. These trades can execute at any point. So in contrast, the stock markets in the United States are open, I think, from 9 to 4. I don't know, maybe you guys know better than me. And so anything after hours has to wait till the next day. But in practice, that doesn't happen anymore, because if a major trader needs a trade executed now, they can either A, execute on one of these platforms, or B, a lot of these companies that are listed in the American stock exchanges are also dual listed. That means people in Bombay trade these stocks, or people in Singapore trade these stocks. And so they can go to a different exchange that's open after hours, and yeah. Okay.
What are the requirements for access to
Good question. Just gonna take a brief look in the book to see if it says.
And who's this paying for? Yeah, like who started these?
Major brokerages and traders. So that's who's active here. I don't know what the official listing requirements are, membership requirements are. I can find out, shouldn't be too hard. But yeah, I'll get back to you on that one. Okay. Yes, all right. Now we get to the downsides. There is no market maker. Pluses, minus. That means if you're the last guy to buy a bunch of this stock before something horrible came out, chances are you're going to lose a lot of money on it, because there's no one who's required to buy the stock from you. And the other sort of broad level bad thing about them, I don't know if it's a bad thing, but why people are pissed off is they steal business from other stock markets. If you guys want, I can talk to you more about indices and or, actually I can't talk to you more about indices, I told you everything. Exchange traded funds is the one unit that I didn't cover here. If anyone's interested, I can talk about exchange traded funds, which are basically large mutual funds that trade like stocks. Any takers? Alright, we'll move on to mortgage markets, they're more interesting.
Mortgage market?
Yes, chapter 14. Okay, am I free to erase here? Okay, so what are mortgages?
Home loans.
Home loans are a very important subset of mortgages. What is the broad definition? Briefly mentioned it. Yes, you can think of it as asset backed. We don't use the term asset backed, that's specific to something else.
Long-term home loans, backed by home.
Asset.
Long-term home loans backed by homes. Or we'll give you a broad definition here is, you had the long-term in, Sam, so credit to Sam for that and credit to Jay for collateral.
Fish it out of the chapter.
I was trying to.
By the way, I caution you from taking everything in that chapter of that book literally, and all the chapters of this book, because I found a mistake in there that was driving me crazy. I was working for 25 minutes. The problem that we're going to get to, we're going to work out here, and they put the wrong input here. Table 14.2. We're going to work on that probably tomorrow or next class. But they had the wrong input here. And this follows a general trend of not everything's perfectly accurate. And I'll ask that you guys give them a break, because there is no textbook that's perfectly accurate. It's just a matter of flaws that you haven't caught and flaws that you have. It reminds me of, does anyone here dive? Anyone's into scuba? Scuba. There's a old scuba joke. There's two types of divers. Those that pee in their wetsuit and those that lie about it. So that's like books. All books are going to have mistakes. Some you just notice.
You dive?
What's up?
You dive?
I did.
Cool.
I haven't been diving in a while. Mortgages. Long-term collateralized debt securities. That means I go to somebody, want to borrow some money from them for definitely more than 1 year. This is again where we wonder about the definition of long-term, because the book defines long-term as anything over 10 years, but there's plenty of mortgages that are less than 10 years. But anything over a year, I go borrow money from somebody for over a year and I pledge some security to it. That means if I don't pay that person back, they can
Seize my home.
seize your home. Your home, not mine.
Is that
So,
like foreclosure?
yes, foreclosure is the process of seizing a asset. Okay, so now let's address what Jay said. Home loans, yes. By and large, Jay, you're right, is that the book says that 80+% of mortgages are home loans.
What does it say after collateral? That word.
Debt.
Collateralized.
Oh, okay. That's it.
Debt securities. Yeah, I am actually questioning this number here, but book says 81% of home loans, 81% of mortgages are collateralized by residential home loans. 81% of mortgages are residential home loans. I think there's probably a lot of commercial real estate loans that they're not taking into account, but anyway. A lot. Home loans represent a lot of mortgages, okay? And one way of thinking about this is there's basically two types of loans here. When we're talking about mortgages, we have fully amortizing and balloon.
Two types of, what's this?
Two types of mortgages. So there's other kinds of loans, but you can classify mortgages in one of these two types, okay? Does anyone know the term amortizing? Okay, Crystal?
It's just a schedule broke down,
Schedule, what does
you
the
know,
schedule tell you?
interest, PMI, private mortgage insurance, and all in one
So,
schedule for payment.
yes, there
Wait,
is-
principal and taxes.
Principal, interest, taxes, those are a lot of things that
Okay.
broadly relate to mortgages.
Never
You're right,
mind.
you got a lot of topics.
Never mind.
We're gonna table the specific definition of those things until later, but amortization just means that the amount you owe reduces over time, okay? So Crystal was pointing to an amortization table, which tells you exactly how the amount you owe reduces over time. It says that period 1, I owe the bank $100,000. Period 2, I owe the bank $99,997. That kind of thing. So
It'll like show what part goes to interest and what part goes to principal.
I'm really going to try to go over an amortization table with you guys next time, because that is something that I almost guarantee each of you will see at some point in your lives. By that point, anything you learn in this class will be long gone, but still, give you some fresh exposure now. So, yes, so amortizing means it's the amount you owe reduces over time. It declines with each payment, okay? In contrast, balloon loans are those that you can think of it as a little string here, and then boom, balloon. So you make little interest payments that
Can't really see that.
you make interest payments, and at the end of the term, you have this big lump sum payment that represents the full amount of your face value. Sorry, I have to be an adult someday. Stop it, Jake. So basically, your interest payments, you make periodic interest payments every period here, and then when the loan comes to maturity, this is usually 3 or 5 years, you have your face value. So that's balloon loans. There's like a little balloon. Okay. Stuff that I like. Can I erase this? Okay. Let's think about concepts. Let's think about.
Don't they do balloon loans for mortgages too?
This is precisely what that was.
They're doing 5 years?
Yes. So okay. So
Isn't there like longer ones than that though? No, they'll always do that fast?
because if you were a bank, how long would you go taking interest-only payments, right? Why would you not want to book a 30-year asset taking interest-only payments? Because what happens? The guy makes interest, and the guy makes small interest payments for a while, and then when the lump sum is due, he says, no thank you, I'm out of here. You can take the loan, I've lived here for 30 years, have at it, I've trashed my house enough for you, bank. So, in order to circumvent this moral hazard problem here, what they do is they do 3 to 5 year balloon loans, and what happens usually is at the end of the balloon loan, if the borrower is still doing well financially, then the bank will reissue another balloon loan for 3 to 5 years, or roll it over. Okay? So this represents, balloon loans were really popular in the early 1900s, and or the reason, does anyone read here for fun? Novels? Yeah? Does
Uh,
anyone read Steinbeck?
Oh, yeah, of Mice and Men.
Mice and Men's great. Well, Grapes of Wrath, you remember anything about Grapes of Wrath?
Yeah. It was during the Dust Bowl.
Yeah.
The Dust Bowl Oklahomans here, they
Mhm.
were
Yeah, there's-
forced to move.
Yep, yep, there's people here, but how he starts that book off is, I think there's a dynamic between a guy and a tractor who's about to kick this guy out of his house, just mow the house over, and the homeowner who basically got a loan from the bank said, look, when times were good, I got a loan from a bank, but now I can't afford to make payments on this loan, and they're not gonna roll it over. They're telling me I need to give them, $20,000, which was an obscene amount of money in the 1900s. And so he can't afford that. So that's because these balloon loans were popular. Is everything's good while you're making these small interest payments, and then if your crop yields have gone down, or no one wants to buy them, or the Great Depression is happening, then you can't afford to make it. Then the banks come in and take everybody's farmland, which is one of the things that really pissed Steinbeck off because he grew up farming. But yeah, so okay. So let's think about residential mortgages first. So okay. When a bank is granting this loan, it has an option of granting a short-term loan or a long-term loan, okay? What's the problem with short-term home loans? Let's say I want to buy a house, I need $300,000 to do it. What's the problem with the bank saying, here you go, Leo, here's a 3-year loan for $300,000? Default risk? Why?
Because it's less likely that you'll be able to produce the payments.
Payments are gonna be really high.
Yeah, the payments are gonna be high.
Yes, the payments are going to be really high. You guys are getting into it. I argue that there's less default risk in a shorter time horizon, because if you have a longer time horizon, you have more time to potentially default. But the thing is, as a borrower, it does me no good to take out a $300,000 mortgage for 3 years. If I don't have the money to buy that house today, what's to say I can accumulate that money over a course of 3 years? That's very unlikely. And so, as you guys are pointing to, what that's going to translate to is my payments being obscenely high, and I'm not going to be able to make the payments. But the concept is sort of the one step behind, is that if I need $300,000 to buy a house now, probably not going to be able to acquire $300,000 over the course of 3 years. Does that make sense? So, short term, no good for borrower. Okay? Let's think about long-term loans, all right? We've narrowed it down to, all right, so home loan mortgages need to be long-term in order for the borrower to sign up for them. Now, when a bank grants a long-term mortgage, they can do one of two things.
So what do you consider short-term?
Pardon?
What do you consider short-term?
What do I consider short-term? I consider short-term definitionally under 1 year. That's my definition of short-term. But realistically, it's under 3 years. You can think of it here too.
Okay.
Just shorter term, I should have said, instead of short term. But basically, a borrower's getting a loan from a bank because it doesn't have money right now. And if it doesn't have money right now, chances are 2 years from now, it's not going to have that kind of money either. There's always.
I mean, it's good for the borrower if he has the money, because it's less interest payments he has to make.
Yeah, no, it's definitely much better. I mean, if you can afford finance. For instance, when I bought my car, I bought it outright in cash, and then I realized, wait a second, I'm actually losing money. I get 3% on my checking account, and I have to pay 1.5% on the loan, right? So I went and took out a loan for $12,000, and I just started making 1.5% payments there, because the percentage rate that I get is so small, 1.5%, that it's worth it, right? If I were to get a 10-year car loan, I don't know if they make those,
No.
3 or 5, yeah. But if I were to get a longer-term loan, there would be more default risk associated. The banks would have to charge me more money because I have a longer time that I can default. But a 3-year loan, they gave me the best rate. Pardon? Yeah, makes sense. I mean, you can definitely make more money in the stock market. So if you have the free cash flow, then go for it. But, okay. Yes, so long-term loans, banks can hold them, or sell them? And one of the questions I asked on the last homework that we didn't unfortunately have a chance to go over is, what's Freddie Mac, how's it different from Sallie Mae, whatever. Freddie Mac basically buys up a bunch of these loans. Freddie Mac is one of several organizations that buys up a bunch of these loans, collateralizes or packages them up into mortgage-backed securities and sells them off to investors. So, would a bank want to hold on to these 30-year loans?
No,
No. Why?
because they're tying up their capital for too long of a term and they can do other things with it.
Right, right. So basically what that's saying is,
Same thing like you in the car.
yeah, I have, yeah, there's opportunity cost, exactly. That's one really good reason. Another reason, that reason's probably better than the one I had, but the one I had traditionally thought of is interest rate risk. Is you don't want to lock in a interest rate of 3%, because if interest rates hike, then you're going to keep an asset on your book for another 27 years that's only paying you 3%, whereas the market rate now is 9%. So you want to get rid of that, and so you have the flexibility. But also, it's because you want to have that capital to deploy to profitable investment opportunities. I think the two are related. I'm just not going to explain to you how I don't know. Okay, so holding is no good for bank. Okay. And here, we have two regimes. Under one regime, it was sold to few specialist investors. Okay, so if these loans were sold to, these loans were given to Fannie Mae and Freddie Mac because they make the secondary market for mortgages, and Fannie Mae and Freddie Mac had only a handful of final end users that would want anything to do with these mortgage-backed securities. And those guys would very carefully analyze the delinquency rates of these mortgage-backed securities and, stop buying. And Fannie Mae and Freddie Mac also used to very carefully assess, this bank, let's say I bought a bunch of loans from this bank, how many of them are defaulting? If a lot of them are defaulting, I'm not going to do business with this bank anymore. That stopped being the case at some point in the last 20 years, all right? In the last 20 years, there is now a lot of players in MBS market. And these players are not specialists. Again, it goes back to the movie, Big Short, yeah, where you have just anyone and their grandmother was into these mortgage-backed securities markets. They're not tracking the delinquency ratios. Real estate never declines in price. At least it hasn't since the Great Depression, systematically. And so it's a safe bet. They don't have to track the delinquency ratios. Turns out they did. And this scenario, the one we're currently under, caused us a lot of trouble because we had people that no longer had accountability to the mortgage-backed securities that they were selling. Nobody really went after Fannie Mae and Freddie Mac, and more importantly, if you guys will remember the loan officers in that movie, The Big Short, I worked with a guy at the FDIC who was just that douchey. He was a former loan officer at another agency or something, and he was just complete tool, didn't know anything. He was just like those loan officers who just originated to get as much revenue as possible, give loans to any one of those ninjas, the no income, no job, no collateral, or no assets. And because your incentives are structured in such a way that you're better off by giving as many loans as possible. And then you sell them to the agencies, and the agencies package them up and sell them to ultimate investors. Now there's a huge market for the ultimate investors, and the ultimate investors aren't doing due diligence. They don't care what they buy. The agencies aren't doing due diligence. They don't care what they buy from the originators, and it's just a bad system. So that's this chain here of residential home loan mortgages led to a lot of crap. Okay. Principal agent problem. Hopefully I'll have time to go over that for a while. Another thing that I'll talk about in the book's terms with a caveat, the book says that interest rates on mortgages actually, I kept you guys 10 minutes late, 5 minutes late last time. Do you guys want to leave early this time? You want to go over this one concept?
Let's keep on trucking.
Keep on trucking, all right. Sorry. Okay, so it consists of 3 components. And I'm going to add a 4th one, but let's go over what the book says first. Consists of market rates, and this is a function of supply and demand for money. We talked about that with the Fed unit. And mortgage interest rates are also a factor of the term on the mortgage. And we sort of alluded to this earlier. The term, just so you guys all know, represents how long this instrument is going for. So 30-year mortgages are always going to have higher interest rates than 15-year mortgages, all else equal about the borrower and the time. So
Supply and demand.
yes, supply and demand for money. So demand for money, you can basically think of how many people want these mortgages, how many people want these loans. Supply of money is how much money do the banks have to provide to satisfy this demand. And the Fed controls the supply, the economy controls the demand, which the Fed can also indirectly control. Okay, the third thing the book talks about, and this will lead into the example that we're going to open with next class, is points. Okay? When you go and get a home loan, you will be given the option or sometimes the obligation to get these points. And these points are 1 percentage point of the face value of the loan. So if I'm going to the bank and asking for $350,000 to buy my house, a point equals, yeah, 3,500. Yeah, exactly. That's right. Yeah, but it's 1% of the face value, okay?
Point
And
equals what? What'd you say?
1% of face value, so. One percent of the face value of the loan. And
What are those good for? What is that?
those are good for, you can think of this as committing yourself to paying more money up front to get a lower interest rate.
It's like a down payment.
Mm-hmm.
No.
You're paying down your percentage points.
What's that?
I don't know, whenever I got mine, I paid it down so that it would be less.
Yeah, that's exactly concept.
The interest rate would be cheaper.
That's exactly it. So the bank offers you I think standard, you'll always have to pay 1 point. I don't know. Don't quote me on this. I don't have a mortgage. But the bank offers you the opportunity to pay more points up front and lower your interest rate. But what Sam said was very obvious and very right, and I'm surprised that the book doesn't have this, but your interest rate is definitely also a function of your down payment. Okay?
How's points not the same thing?
Because your point represents a small fraction of your down payment. If you buy any sort of instrument, you're going to have to invest your own equity just to show the bank that you'll care if you lose this. For instance, if you get a home loan and invest 1% of your own equity, say I buy a house for $200,000, put in $2,000, what happens when the market value of the house goes down to, let's say, $175,000? Well, why would I continue to pay money on an asset that is no longer worth, how much money I'm having to pay for it? In contrast, if I put in 20%, which is, to my understanding, pretty typical down payment, then you have a strong buffer. 20% of 200,000 is 40,000. So if it's 175,000, I still have incentive to make payments on that loan. I'm still getting equity, still a positive NPV project. We'll go over all that stuff in detail in the amortization table.
So you would say, okay, I'm gonna give 20% down,
Mhm.
but then at the signing, you could always add on top of that, well, I'm willing to give another discount point to reduce it even further.
Exactly.
I think it was 1,000 per 0.5%, or
Pardon?
I think it was 1,000 per, like, I wanna say, I don't know, never mind. It's been a
So-
while.
It's gonna, how much this point is gonna depend on the value of your house, how much it's gonna save you in interest rates is gonna depend on the bank, but that's basically it. So, down payment, I argue, is the fourth relevant thing, at least the fourth, there's probably more than that.
Okay, so what's the first, second, and third?
So there's three components. Market rates are going to determine how much your bank charges you. The term of the instrument is going to determine how much the bank charges you. The amount of points that you sign up for is going to determine how much the bank charges you. And finally, your down payment is going to determine how much the bank charges you.
Question.
Yep.
So the points and down payments, is like the difference between points and down payments, like points has is what's required to reach a certain spectrum of like the loan, to value, so that your interest rate can be lower while the down payment is actually on top of that?
I argue that you will fall into different rates depending on your down payment. Let's say that the minimum down payment is, let's say, 15% for this institution. If you put down 15%, that's fine. If you put down 50%, you're not at risk. There's no way you're going to default on this loan. We'll be able to cut your rate substantially.
No, and I know that aspect of, that's the point, though, right?
So-
Well, the down payment does.
No, that's actually the down payment, because you put down 50%,
So
that's
what's
your
the
down
points
payment.
again?